Okay, good afternoon, everybody. Thank you for joining this InvestEngine webinar in partnership with HANetf, which is all about regular investing. I'm Andy Prosser. I'm the head of investments at InvestEngine, and I'm joined today by Andre Vornia, who's the head of European sales at HANetf. Now, in terms of the plan for the webinar, it's going to be a bit of a Q&A. So I've got a few questions which I think people will likely want to know the answers to about investing trends in the world of ETFs. How investors should be using ETFs, things like that. So we'll start off with some of those, but I'm also going to be picking questions from the Q&A section of the chat at the end of the webinar. So if you do want to ask questions as we're going through the webinar, you can click on the Q&A button. There should be a little square Q&A button in the bottom of your screen. The questions won't be broadcast to the whole webinar chat. They're just going to come straight to us. So don't worry if you think you've got a stupid question. That's absolutely fine. Just feel free to ask away and we'll answer as many as we can as we go through. I need to make sure I leave enough time at the end, probably kind of 5 minutes-ish for a quick demo of how to buy the ETFs that we're going to be talking about today on the InvestEngine platform. So I'm hoping that once we've finished with the Q&A and the platform demo, we'll be ending the webinar at about 5:45. Right, before we get going, one final thing to mention. I do need to mention the usual disclaimer, which is, thank you very much, that your capital is at risk whenever you invest. This webinar is for UK clients only, and that none of this is financial advice. Okay, with that, I'm going to hand over to Andre to give a quick intro into who he is, who HANetf are, and then maybe as a first question, Andre, you can kick us off by giving us your thoughts, maybe on some general trends that you've been seeing, maybe starting with how you've seen ETF adoption change over the last few years.
Yes, will be my pleasure. Andrew, thanks for having me. Good afternoon, everyone who tuned in today. So just a quick word about myself. Andrew, you already said it. I'm looking after the European sales team here at HANetf. Some of you may have heard of HANetf. We're not that new anymore, 6 years in the market now, but we're not iShares, so some of you may not have heard of us. Just a quick word. I think the part of the name HANetf will tell you all you need to know. We are an ETF issuer. Han, it has nothing to do with the Chinese Han dynasty. It's the name of our founders, Hector and Nick. So they made themselves immortal in the name, HANetf. We came to market with a bit of a different idea than the other incumbents like iShares, Vanguard, Xtrackers, and so on. We offer a platform for external wealth managers and then entrepreneurs to launch their own ETFs with us. So we take care of launching those for them. They bring the idea and the strategy, and we take care of the implementation. And then we also speak to investors such as yourself about these strategies. So you find all kind of innovative things on our platform, market access products, these kind of things. So I leave it at that for now about Han. I'll talk a bit later more about some of the ideas we have, and we actually brought you a couple of interesting themes fitting hopefully to the current market environment. But I'll come to that later. I myself have been working for over 15 years in the financial markets, and I've been in ETFs for most of that time. So I've seen quite a lot of the change that has happened over that time. Hopefully, I have a couple of interesting points that I can share with you, a couple of nuggets of knowledge which I've observed along the way. And Andrew, to your point, to start, maybe what has changed in ETFs, what has driven the evolution, and maybe you could call it revolution even, of ETF adoption, particularly in the private investor space in Europe. What I've observed, so I've maybe you hear it from my accent. I'm German originally, from Germany, and Germany has evolved into probably the biggest market for ETFs in Europe. That has not always been the case. When I started back in 2010, 11, 12 to really dive into the ETF industry here in Europe, Germans, and I think probably many investors across Europe, still were much more likely to save their money as in a savings account, for example, a fixed term account or somewhere where you get an interest rate for a year, 2, 3. Because it was perceived as something safe and a guaranteed rate. You don't have to take risk. Equities or stocks were perceived as risky. They can fall. You can lose your money. So there was a lack of education. Probably people did not feel that comfortable. I think what changed dramatically was the financial crisis in '08. So back then in '08, suddenly rates dropped to zero and partly negative during the last 15 years. It's only recently, the last year, if you think back on 2 years, that we actually saw rates again, high rates above 0.5 or 1%. So those last 15 years really led to a change in investor behavior because investors were looking for other sources of income, both private as well as professionals. We've seen it across the whole spectrum. So in one reason I think why Germany then became one of the leaders there was because there was a confluence of several factors. One was that people were searching for alternatives, and Germany never had a big equity culture or stock culture. I think the Anglo-Saxon space, England, UK, the US, they are more prone to invest in equities. It's something that's more in their culture. But when the private investors in Germany were looking for alternatives, the brokers also and the financial providers and in the market also made a step towards these investors and said, okay, I will offer you an alternative, how to invest with us, whether you have a lot of money or little money, whether you're young or old, risky or risk averse. We will give you a tool that you can use. And ETFs were really the tool of choice in the end because they are transparent. People could see exactly what's going on in there. They were very easy to trade. Intraday, you can trade them any second, basically, on the stock exchange. And you can trade them in very low denominations of, £10 a share, for example. So all these factors were very friendly for retail investors. And then the brokers really made a step towards these investors and said, we'll provide you with education. We'll tell you how it works, what these products are. And importantly, they also made them available as investments in different shapes and forms, either as one-off investments or, as we'll come to talk later, savings plans, which have been one of the greatest, I think, financial product evolutions in the last probably decade that you've seen in the market, which really democratized investing. So I keep it at that. In a nutshell, these are the factors which I personally saw driving that market. And it's happening not just in Germany, but also across Europe. And if you don't mind, I actually brought some charts that I would like to show.
Yeah, please.
Exactly. So this chart, what it shows you, I just touched on savings plans as a tool, which was basically invented. I'm not even sure if it was invented in Germany. Wherever it was invented, doesn't matter. But the Germans or the German brokers really made good use of this tool because the idea was they said, hey, we have a big population, large population in Germany, as does UK have, as does Spain or France have. And they said there's a lot of young people and maybe people who don't have large amounts of money, who are not going to a private bank or financial advisors. People who want to save 100, 200, 300 pounds a month, right? So smaller amounts, as do I. I put aside 100, 200, 300 quid every month in a savings pot. And then the question is, what do you do with it? And these brokers said, you know what, we can offer you at very kind of low rates at low cost. They created an offering where you can recurringly invest small amounts of money. These days, you can invest with some brokers as low as one pound. Most brokers offer 25, 50, 100, around that level as a minimum investment per month, which you can then invest in an ETF of your choice, sometimes in baskets of ETFs or across different products. That's what's called a savings plan because you make it recurring. You set it up once and you say, I would like to invest every month £100 into this ETF or these baskets of ETFs. And then this is done again and again. And this helps you to have a certain discipline to invest regularly. And this really makes a difference. Over time, it sounds a little 100, but over time, including the growth of the capital, really can really lead to a significant amount of savings over time. And they also made them very low commission. That was important. And I think we'll come to that. Maybe I think the UK can certainly catch up in this regard a bit more to offer more like InvestEngine does, to offer this functionality to investors, low cost investing at small amounts. And you see the growth here. It was for a long time, Germany was the leading market here. But recently, and that's actually very nice to see, the orange part is rest of continental Europe is really catching up. So the relative growth in recent years has gone from 500,000 savings plans last year to this year 1.3. This is almost tripling, whereas Germany is already coming from a high level, so it still grew very nicely, 30, 40%. But continental Europe is really catching up, and I wouldn't be surprised if UK will follow a similar path. And if you can go to the next slide. Here you see the investment amount. So on the other page, we saw the number of savings plans. Here's the investment amount, and we see a similar picture, a doubling of the investment amount in continental Europe, a slower but still significant growth in Germany. And then also the picture looking forward, we see how continental Europe is looking to catch up massively in the next 4 or 5 years if these forecasts are to be believed. And then on the final slide, please, just one further. This is just a part, it's not savings plan specific. This is investment from private investors or retail investors in ETFs across in general. And this is also great to see how since 2014, and that's now the last 10 years, it has slowly started to grow, and it's really taking off more and more. And we have today already 260 billion invested in ETFs. And it's looking like we can almost triple that in the next 4 years. So it's a massive kind of investment revolution here in the ETF space with private investors. Thank you. Sorry, that was a very long answer to your first question. But I hope
very thorough and comprehensive answer. No, that's a great way to start. Thanks so much. I was at an industry conference, I think it was a couple of months ago, and one of the amazing stats that I learned there was by 2026, 1 in 4 Germans will have a savings plan set up. And that absolutely blew my mind. It's amazing how ubiquitous the ETF vehicle and savings plans are in Germany. Obviously, we're a UK-based investment platform. So my next question for you will be, how can UK investors kind of replicate that success that Germany's had in terms of being really good with investing regularly, small amounts? What can UK investors learn from the great example that Germany's setting?
It's a good question, and I read your report that you published not long ago, where you looked at the German market and compared to the UK. And I myself see myself as a UK person. I've lived here for 15 years now. UK is home for me, and what I've experienced over the last 15 years is that I don't think the investor in UK is that different, right? They have similar amounts of savings. From what I saw, there was a BlackRock study. Everyone. It's just about what we are used to investing, and what I've learned in the time I've been here is that housing is a very important part of the UK investment mentality and savings mentality. That has become more difficult because house prices have really gone up. Many people can't afford to get on the housing ladder, especially the younger people. In Germany, there was not that much the case, and I think what the ETF and the savings tool via ETFs or investment in the stock market is actually a great first step to get to an amount of savings that's big enough to achieve certain life goals, like, for example, a house, sending children to university. There are even companies or brokers or yourself who say through ETFs or savings plans, regular savings, you can save towards these goals, and then they give you a path, and there are calculators out there who say how much you need to save to achieve certain goals with certain assumptions. So I think what's important is education as a first step. Because the German ecosystem has provided education about ETFs for a long time now, and even there, it's still there's still work to be done, but many people do feel more and more comfortable. I go to industry fairs all the time. There's big retail exhibitions where you go and you talk to investors directly, and they ask questions, so they understand ETFs by now. I think what you do is exactly the right thing. You start with the education, you do these webinars, you tell people about what ETFs are, how they work, why they make sense. And then importantly, once you do that, you also need to give them tools at hand to be able to implement those views. And I think the UK industry could do a better job there. And look, I'm biased because I work in the ETF industry, as do you. There might be others who say, my funds, my OICs, my other things are equally good. I personally think the ETF wrapper is the most modern technology you can have to wrap equity investments in, because, as I said, it's transparent, it's liquid, it's low cost. So all the characteristics you want as an investor. So let's tell people about it and make sure they understand and know they exist and what it is about, and then give them a tool, create savings plans, make them able to invest small amounts regularly, recurringly at low cost. And then people will come. This offering needs to be there, and I think that's where UK is still lacking a bit.
Well, that's kind of music to our ears, given that we are a low-cost, long-term investing platform. So hopefully we're in the right space. Speaking of ETF, sticking on the kind of ETF wrapper and why it's so good. how do you kind of see ETFs evolving? Obviously, they've been around for a while now. We've seen some really interesting innovations come through in the industry recently. We've done some good webinars on bullet shares ETFs, on active ETFs. But how do you kind of expect the ETF wrapper is going to evolve over time?
So the ETF wrapper, exactly as you say, it is, and that is important actually for anyone who's listening now, because people often say, "Oh, an ETF, I invest in an ETF." Just to be clear here, the ETF is the wrapper. When we say wrapper, and people say, "Oh, what is a wrapper?" It's like a technology, if you want. It's as if you pay with with a credit card or with tap. And I like to to actually make this analogy. Say we used to pay with cash. Then we said, oh, actually, credit card is a bit more convenient. Let's pay with that and PIN. Then you did the tap with the card. And now you got all your cards in your phone on one app, and you tap your phone wherever you go. It's incremental evolution of what existed before, like a fund. Before we had funds, we had shares, then we had funds, then we had now ETFs. It's a superior technology that just advanced what was there before, but it's just something that you wrap around. In the end, what's underneath is a technology basket of stocks, for example, 20 stocks of that, or you invest in 20 bonds, a bond from the UK government, a bond from the US government. ETFs have become very versatile. They can wrap almost everything and anything you kind of want to have. There's a couple of restrictions, maybe private markets and illiquid stuff that's just not that much doesn't work well. But it's been incredible. Initially, ETFs were there to just wrap a stock index like the S&P 500. That was the very first ETF in the US. And then over time, it evolved to have not just equity indices, but bond indices. And then someone said, oh, I would like commodities to have as well. Well, you know what? Commodities are not that easy to wrap because the regulation doesn't allow it. The ETF industry, or the ETP industry in a wider sense, found a way around it. And we created something called an ETC. And suddenly you can invest in that in gold or in oil. And then there were investors who like, oh, could I maybe invest in a 2 times leveraged FTSE 100 because I have a certain view of the world? Sure. Then you had leveraged ETF. Then someone said, you know what, I think the market went too far. I want a short product. You had short ETFs. You can short certain markets. It's really, the creativity, you can create so many things. And as you said, we've seen new asset classes come to market. Crypto is not yet available in the UK. I know it's not something we can offer here. It's been a big boom in Europe. I'm pretty sure at one point it will come to the UK. Like I said, you have certain funds and multi-asset funds that come where I say, okay, you are at a certain stage in your life. Maybe we mix equities and bonds and pack them into an ETF, like your whole portfolio. Or you make model portfolios in a whole ETF. I'm sure there will be something to come for the future. So it's really, you look underneath, you say, what does the investor need or want, demand, or what idea do you have to offer, which could make sense? And then you just wrap it into an ETF as long as it's liquid. And there will be, if you have ideas, that's actually our job at Han. People bring ideas to us. And if there's an idea, we'll try to implement it.
I think it can be quite overwhelming for your investors because, as you say, there's such a big, broad spectrum of different things that you can invest in. With ETFs, it might be worth just giving a bit of a primer and just highlighting the main ways that investors can use ETFs and the kind of exposures that investors can get with ETFs.
Yeah, so fundamentally, if what's the going back to the German example, what Germans like to do, and I think in general, people who like to save for the long term, and they say, okay, I will invest small amounts every month, £100. The MSCI World, for example, which is the global stock index, it's a broad index of stocks. The core idea initially was say, you know what, let's say you're a young person in your 20s, 30s, 40s, then equities have the highest risk if you look at the different asset classes. But if you have a 10-year plus time horizon, they're normally not a bad idea because yes, they have high risk, and risk is measured by volatility, that stocks can go up but also down. But if you have a long time period, historically we have seen that stocks tend to go up because the economy evolves, the world is getting hopefully better, and even though we have setbacks occasionally, on average, there's economic growth, so these companies gain in value. So long term, you want to be in equities because it normally creates the best return for your money, more so than just saving in cash. And there's plenty of studies showing that.
Yeah.
So as long as you have that horizon, people said, okay, I will take a broad diversified basket like the MSCI World and just allocate to that on a monthly basis. That's what we call a core allocation to your markets. Some people then mix it up with bonds and they say, okay, I take UK Treasuries and the FTSE 100, for example, and I have 2 savings plans on these 2. And then some people become more adventurous or more, they have certain views of the world. They say, look, I work in tech, I believe in technology. I think the future of the world will depend on that. I would like to invest in a stock basket which is specifically benefiting from the growth in tech. So then there's plenty of ETFs out there that offer you exposure to technology. So then you mix in what we call a satellite position. You have your core allocation and you say, okay, let's take a little bit of my money. Maybe, I have 100 here, 100 there, another 50 in that. Or you could say, you know what, I have high conviction. I really believe that technology is the thing forward. Then you make it a core allocation and it fits with it's important that investments also fit a bit with your belief system. That's my personal belief, at least, that you align there. We have seen, for example, investors who created for themselves sustainable portfolios, where they said, I believe the world needs to become greener, less CO2 emissions, more fair, more equal. And there are plenty of ETFs offering exactly that. So you go there, you look for the ETFs that reflect that value system, that worldview of yours, and then you pick them. The nice thing about the ETF is they are by definition already diversified. So you don't have the risk of a single stock where something could really go wrong sometimes. So even if you make a wrong investment decision and think that your view doesn't pan out, it's normally not as catastrophic. It can't be as bad or as consequential as having a single stock, because the diversification in that basket will protect you. So that's just something inherent in ETFs. And then, finally, just to one other example, some people like to be tactical. They have their core allocations. They feel comfortable with the core of their savings in, a couple diversified ETFs across different asset classes. And then they play tactically. They say, okay, I have a view that, Donald Trump is president of the United States again, and maybe this will benefit Tesla is a single stock example, but because of Elon Musk, but let's say the oil industry.
Yeah.
Now, not everyone might agree with that, but he said openly, I'm pro-oil. So maybe you choose a oil and gas ETF and you say, I'll take that as a tactical bet. A tactical bet is something that you take a 6, 12, 18-month view. And if it pans out the way you want, maybe then you cash in and you say, I'll use that money for another tactical idea. And it's some money that, you're not depending on as much as your core allocation, which you need for your core savings. That's also a way that some people tend to invest.
Yeah. So speaking of ways that people tend to invest, I can see behind you in your background there, we've got a list of different kinds of themes of funds that HANetf specialize in. So I'm just kind of curious which of your ETFs are proving popular at the moment, and maybe some of the reasons behind that, if you're able to go into that.
Yeah, sure. And actually, probably looking at my own screen here, one of them, the future of defense, which you see with the shield there, has been the most popular theme actually of this year. Well, you can say unfortunately, because I don't think anyone wants conflict in the world. But ever since Ukraine-Russia happened, clearly there's been an uptick in demand, for defense investments from governments and countries, and the companies have benefited from that. They've had great performance. We launched an ETF on that last year. It performed very well. We had a lot of investor interest. I think we were close to 600 million asset under management, which for such a niche topic, we were one of the very first to bring it to market. It was astounding, but that's how sometimes markets can evolve. I actually brought you a couple of ideas. If you don't mind, if you can show I have 2 more slides just on that note, because the world has changed a bit again last week when Trump was re-elected. So the US is the biggest equity market in the world. They have significant impact on performance, of course, of the US market itself, but also global markets. So a lot of the decisions made in the US politically, economically, reverberate across global markets. So we looked at it just this week. Our research analyst looked at it, and we came up with the following policy impact, which we expect. Again, this is not advice. I can't promise you that this will pan out, but having looked at the market, we think that's what could happen. So there's a bit geopolitical uncertainty because Trump has been quite volatile in his approach to foreign policy, whether with North Korea, with Iran, who knows what will happen with Russia. So while he said he will end these conflicts, the uncertainty there is, I think, what drove. You literally could see a spike in the price of defense stocks just a day or two after he was elected. So that's one theme. Protectionism. We talk about that. America first, US first. Pro oil and gas. He said that as well. Deregulation. He wants to cut red tape for companies in the US. Tax cuts. He's done it in the past. People expect he might do it again, or at least make those past cuts permanent. And maybe a healthcare reform. Republicans have tried often, have failed so far, but could come again. And if you go to the next slide, we try to link these policy outcomes to actual investments and how that could be connected. So here's a couple of ETFs that we offer in the UK and across Europe, which we think could potentially benefit from these trends. The future of defense, I already mentioned it. It did have a fairly significant spike in performance in the last week. And we've seen actually significant increases in inflows. So people clearly see that as a investment theme that is important under Trump. And then gold. Gold is a typical hedge, and hedge means like a protection against uncertainty in the world in general, geopolitical particularly. Also things like inflation. So often people go to gold when things are uncertain. That's why we took it here, and we said, it might be an interesting idea in the mid to long term to look at gold. You can invest in gold in two ways. You can do direct investment in gold via something called an ETC, which is basically the brother of or sister of the ETF. Very similar structure. Or you can do gold mining. These are equities, so stocks in gold mining companies. And then oil and gas, I already touched on that. We think he'll be pro oil and gas, particularly in the US. We did launch 4 or 5 years ago already a fund that invests in the infrastructure in the US. The US has big oil and gas fields. They're the biggest producer actually in the world. And this fund invests in companies that create pipelines and storage capacities for gas and oil. So it has already had a very good performance, and we think it can benefit further under Trump. And then technology. Maybe some of you have already invested in technology. It's one of the most popular sectors out there. Many people will know the NASDAQ 100, which is a classic benchmark. Many use that as their core allocation for technology. It's a very long-standing index, and there's quite a few ETFs out there on that. We launched an alternative to that. Anyone who's looking, the NASDAQ 100 is very top-heavy, meaning it has 100 stocks in there, but the top 5, 6, 7 stocks make up 40 to 50% sometimes of the index, depending on the environment. So you really take a bet on these big companies like Google, like Amazon, like Apple. So if you think that some of the smaller companies might benefit because Trump is cutting red tape, maybe he'll do some, bit stimuli, but helping them, the incumbents with the protectionism stance, where the local domestic guys do better. We created this alternative where we have a couple of some of the bit smaller companies in there. We weight them more equally. So it's an interesting idea for people who like tech. And then I mentioned healthcare. We recently partnered on something that Andy, you mentioned, active ETFs. That is one of the latest trends that came to the ETF world. This is an example of it. So it's one of our newest actively managed ETFs. So we actually have a portfolio manager behind it from the United States. They have over 10 years experience. They've run a successful strategy of healthcare in the US. They've come to Europe. They've launched this ETF newly with us. And they have their approach is very much focused on growth and innovation. And we think if there's policy upheaval and should they change the laws and the way the US healthcare system is regulated, there's a chance that these innovative companies will have an edge versus some of the big incumbents who might be a bit slower to adapt to the new situation. But there's a lot of flux there. So it's just throwing out the idea there. Watch the healthcare space. And if you think that's something for you, maybe do a bit more research, have a look at that, and keep in mind for once the policy actually starts moving. So yeah, I'll leave it at that. That's our how to position for Trump trade.
Yeah, really interesting. That's a really good selection of ETFs I think you've got there. Just curious, and I'm conscious of time, so last question before we start getting into the platform demo stuff. How are you seeing those ETFs being used in portfolios? You mentioned the kind of core satellite approach before. Are they being used in the core section? Are they being used as satellites? Is it a bit of both? How are you seeing clients use them?
So in the past, it depended a bit. When you saw ETFs like some of the ones that I described, I said we as Han, we are very much in the thematic equity space. Thematic equity has been something of a kind of new frontier where you look at mega trends, long-term trends, and you say, okay, I think robotics, technologies, cloud computing is the new thing. But it was a bit more because it's new, they're a bit more volatile, a bit more risk there. So people used to use them as satellites, so as an add-on to their core positions. But we've seen some change there now as well. For example, that Future of Defense ETF. While initially it was perceived as a bit of a satellite, some people who I talked to took the view that defense is, again, for better or worse, something that's here to stay. This is not going to change. Once people are so scared of conflict, and we've realized that this new age of this multipolar age is here to stay, China, Russia, Middle East, US uncertainty, and these waves of defense building new projects, whatever, tanks, fighter jets, so on. That's not something you do from today to tomorrow, 1 year, then you stop. It's a multi-year process, maybe a decade-long process or longer. So we've seen some people who said, this is a core allocation for me. I'm doing a savings plan on it, and I keep investing small amounts for the kind of foreseeable future. So these things can really change, and it depends on your view of the world. Some people, as I said before, think technology is the thing. So they decide to use a tech fund as a core allocation. Some others say, nope, I'm more conservative. I'm not so risk loving. I take a broad index, MSCI World, and then I use these more kind of exotic, boutique, new ideas, whatever, as an add-on. So that's how people normally use it. I've described before, there's tactical investments you can do. It's really up to you. What I would recommend is look at your risk level. Maybe use a tool. Maybe you at InvestEngine can help them to find out a bit, understand how comfortable you feel with these allocations, and then based on that, make your selection.
Yeah, we absolutely do have that. So if you sign up if you go onto the InvestEngine website and go through the process as if you're going to invest in a managed portfolio, as part of that process, there'll be a kind of 10, 11 question-ish risk tolerance questionnaire. They're all kind of very easy questions about your capacity for loss and your tolerance for risk and things like that. And at the end of that, it will give you a suggested InvestEngine portfolio. You don't have to invest in that. You can just use that as a gauge to see, right, where am I on the risk spectrum? Am I an investor who is quite cautious and I should have more of my portfolio in bonds? Or am I an investor who can afford to take a bit more risk in portfolio, so should have more in equity? But that is part of the managed portfolio sign-up process. You can do it without creating an account. It's very simple to do on the website if you are curious to find out your own risk tolerance. But thank you, Andre. That was a really good answer. Right. In the interest of time, I am going to share my screen now and get a platform demo up and running. Bear with me. There we go. I should be sharing my screen now. Good. Okay. Yeah. As I do this, feel free to keep the questions coming. If we don't have a chance to answer them today, then we'll do our best to get back to you after the webinar. We've got Charlie in the background who's going to be copying and pasting all the questions in the chat. But anyway, on we go with the platform demo. We have a dummy account here to walk through. Once you're logged into the InvestEngine app on your phone, it's also accessible on the web browser. You can open a new portfolio or you can select your existing one. I'm going to go into this DIY portfolio here. We've got, as it loads, we've got 50% equities and 50% bonds in here as kind of target weights. If I scroll down to my portfolio here, you can see we've got 2 here. So to adjust the portfolio, we go to add securities. It's all very intuitive. And where you will find the really cool ETFs that we've been talking about today is if you scroll down in this collections section here, click on thematics. And you can see at the top here, we've got a nice big handy HAN ETF tile. And if you click on that tile, it will bring up the HAN ETF page. And you can see at the top here, we've got loads of good articles from HAN talking about defense, talking about India's internet boom, all that sort of good stuff up there. We've got the ETF list down here. We've talked a lot about the future of defense today, so we'll just click on that one. And what we're going to, yeah, we can see that spike you're talking about here in the last week. That has really done quite well. So I like the look of that. I'm going to add that to my portfolio. Very good. You can see that's been added in the top right there. I'm going to continue. And then this is the screen here where you adjust your weights. So when we were talking about kind of core satellite before, this is where you figure out how core is it going to be, how satellite is it going to be. I am a big believer in the future of defense. So I'm going to take out all of that. I'm going to put 50% in this future of defense ETF. Very easy to adjust your portfolio. You can then, this is a cool tool for those that haven't seen it before. It's called an equity look through, and it basically gives you an X-ray of your portfolio. So you can see how much of your portfolio, both before the adjustment and after the adjustment, how much of your portfolio is in which region, in which sector, and down to the in which holdings. So you can see Palantir Technologies must be a big weight in the future defense ETF, because that's gone from a less than 0.1% weight in the old portfolio, which had the kind of global tracker in it, up to 2.6% now. So quite an interesting and useful tool there. So save and continue. Target weights are all updated. Very good. And then we should be able to see that. Here we go. Future defense, we have it as a 50% target weight in our portfolio now. It's at a 0% weight because we haven't rebalanced yet. But when we do rebalance it, we'll go up to that 50% weight there. All we have to do is fund the account or set up a savings plan. Now, the title of the webinar here is regular investing. So I think it is probably worth me just very quickly touching on how to set up a savings plan on the platform. So we have the invest now, that's just add a lump sum. But up here, we've got set up a savings plan. So if we click that, this page here just tells you what a savings plan is. It's just, as we were talking about before, a way to invest regularly. This screen here will give you the options of how much you want to invest. The minimum is £50 a month. So I'm going to stick in 50 quid, why not? And then we select which day of the month you want that 50 quid to come out on. I'm going to say the 5th day. Just a little tick box to confirm that you agree with the direct debit terms and conditions. Continue. You'll have a final confirmation saying that you're paying £50 on the 5th of each month into the DI1 portfolio. Obviously, this is a demo account, so I'm not going to click confirm details, but that is what you would do if you're going to set up a savings plan. Now, before we get into Q&A, I'm just going to touch on one final thing, which I think is interesting and will be useful, especially when tying in with savings plans. In terms of automating your investments, if we click on options here, we've got this auto invest available cash option, which is a really good one. If you select that, there's a little kind of bar here where you can toggle on and off investing the spare cash. And what this means is that if cash comes into your portfolio from your direct debit, if you have auto invest on, that will automatically get invested in the ETFs in line with the target weights that you've specified. If you don't want to invest everything, you can keep a cash buffer and you can select some options around that. But this is just a really good way to make your portfolio kind of really automated, and so you don't have to think about it. It's a real set and forget option. And I think a lot of clients, a lot of investors on the platform do enjoy the kind of automated aspects of the platform. So with that, I'm going to stop sharing my screen. We've got about 6 minutes for questions. Let's have a look and see what we've got. Wow, we've got quite a few questions in chat. Okay, well, I'm likely to get through all of these. I'm sorry if you have asked the questions and we don't get to it, but as I said, we will hopefully get back to you. Right then, let's have a look. We have a question here about them. This is actually one I get quite regularly, but I'll get your opinion on it, Andre, if that's all right. Somebody here in the chat has 7 ETFs with InvestEngine. Do you think that's too many, or do you think that's a kind of reasonable number of ETFs to have in a portfolio?
No, I don't think 7 is necessarily too many. Again, it really depends on what they are. If you already have a world portfolio and that's your core, then you might need only 1 or 2 to overweight your worldviews, but maybe you have a worldview on different asset classes. Maybe you have 1 on technology, 1 on gold, 1 on bonds, 1 on one on US bonds, one on European bonds, one on oil, and one on something else. So sure, you can do 7. That's not fundamentally an issue. And it's great great to see a tool where you can actually see how your exposure increases or decreases with different allocations. In the end, maybe if you buy the 7 different ETFs and then your tool says, hey, be careful, you got the same stock in all 7 of them for whatever reason, and suddenly that one stock gets to 10%. Maybe you'll say, okay, maybe I have a bit too much overlap. Maybe I didn't consider that these sectors are overlapping. Have another think, look at it. But fundamentally, 7 is not, there's no right or wrong number.
Yeah, I think the key is that you're diversified, right? If you have
Correct.
7 of the same ETF in there, 7 blockchain ETFs, for example, then you're not diversified in that. You probably don't need 7 in there. You only need 1. But the point is to make sure that you are investing in line with your risk tolerance, and the ETFs that you have in your portfolio should reflect that. It can be 2, it can be 7, it can be 10. The number doesn't really matter so much as long as your portfolio is diversified.
Correct.
Actually, that's probably a lead on to another question that we've got here. What sort of factors do you think should investors be considering when they choose their ETFs? Obviously, there's a lot of different people focus on cost, but there are a lot of factors that go into choosing which ETF they want exposure to. So how would you kind of go about whittling down the options and recommending ETFs?
So there's a few different ones, and there's no single factor that is right for any allocation. The core ones that people look at, for example, are cost, liquidity. And when I say liquidity, some people look at, how much does it cost to go in and out? And that's already getting a bit technical sometimes because not everyone is maybe comfortable to look at these liquidity levels. But again, an emerging market ETF will be a bit, you'll pay a bit more to go into it, but maybe you expect more return from that and you expect a long-term performance. So it'll be fine for you. Analyzing, the cost level, certainly if you have 5 ETFs who are the same, you have 5 times an MSCI World ETF. Of course, if one charges you 0.4% and one charges you 0.1%, there's an argument to be made that if you get exactly the same, the cheaper one is probably the wiser choice. But there are fine details sometimes, and the cost itself can be sometimes misleading. Sometimes you look at cost, there might be a reason why that particular provider charges the cost. So it does help to look a bit in the documents then and say, okay, let's look at the fact sheet. Maybe let's look at if they have something like a methodology document where they describe what they do and how they do it. Maybe compare, there's comparison sites. Maybe on your page you can do it. Have a look at the past performance. Maybe the other one consistently outperformed a bit more, even though it charges more, because they do something slightly different that justifies that extra expense, which you haven't initially figured out. So cost is important, but look under the hood. Size, of course, people like to look at size. The automatic kind of connection is, if someone's big, other people invested, so it must be the right thing. So let's go with that. Yeah. Sometimes that can be correct. Sometimes it can be, put this way, it doesn't have to be wrong. Probably a good fund because many people do it. But there's often many small and young funds who do a very good job, sometimes a better job, because they come a bit later. They learn certain lessons which the first ones might not have had the chance to learn. But they're small, so people look at them like, oh, nobody invested in there. There must be something wrong with it. That's not the case. It's a bit of a psychological barrier. Take a look at the smaller guys sometimes, especially if you look at new exposures, which you find interesting, but maybe they're fairly new to the market. Look at all of them. If there's 3 funds, 1 is large and 2 are small, take a look at the small guys as well and have a bit of a deep dive into what they do and how they do it. You might find characteristics which you prefer. So, it's important to do your due diligence and go on the webpage of the issuer. You normally find a lot of information there.
Yeah, I think that's a really good point. Because there are a lot of ETFs, I think, especially in the thematic space, that have very similar names, but actually once you get under the hood, they do very different things, and the underlying stocks that are in the fund are very different. And 9 times out of 10, that'll explain the difference between a fund that's charging 12 basis points compared to one that's charging 45. The one that's 12 is probably some sort of tracker, and one that's charging 45 is doing something very specific and kind of more niche exposure, which is what clients want sometimes, depending on what they're looking for. Right, I'm very wary that we're coming up to time. We've got loads of questions. It's really good to see people getting so interested in the topic. I think one that you'll hopefully be able to answer is one about hydrogen theme. I see that you have a future of energy ETF. So do you have a kind of view on the hydrogen theme? How popular has that ETF been?
Hydrogen has been a very it's been a love child of the Germans a long time. They really like their hydrogen, and I've had many questions in the past. Some people believe hydrogen will be the future, not electricity. There's really like a fan club which really bands together there. So far, again, I'm not an expert there. Please take it with a pinch of salt when I say. From what I heard, electricity is still the dominant technology. There are certain use cases for hydrogen. The question is, can we produce enough of it, and so on. Uh, there are some ETFs out there. We had it mixed in as exposure to some companies in our funds. We have not had yet a pure play one. It is still a niche theme. Look, watch the space. It's early days. It's difficult to make a prediction right now whether that technology will be successful or not. So again, if you want to take an allocation, take a small one. Dip your toe. That would be my personal approach. Again, everyone has to make their own decision on that. It's exciting, but it's early days for hydrogen.
Yeah. I've seen a few questions come through. We're going to have to call time on the webinar because we've just gone over time. But I have seen a few like quite similar questions about, when's the best time to invest? Should you invest a lump sum all at once, or should you drip feed? We'll answer that one later. There's loads of good graphs and stats and stuff that I think would be really good for kind of backing up the arguments and for one versus the other. So if you have asked that question, sit tight and we'll get back to you with the answer to that one. That is, I'm afraid, about all we've got time for. Yes, we'll get back to you over the next few days if we haven't answered your question today. You can always email support@investengine.com with your question, and we'll get back to you that way as well. But as we were talking about before, if you do want to find out more about any of the HANetfs that we've been talking about today, or you want to have a look at their full range, then you just click that HAN ETF banner at the top of the collection. So you go to collections, you go to thematics, and then their tile will be at the top there. And you'll find all the details about all their ETFs on that page. So all that's left for me to do is to say thank you so much to Andre for joining. I think that was a really interesting chat. Thank you, everyone, for joining us and tuning in today. And we'll see you next time.
Thank you, Andy.